All right, guys, welcome back to We Talk Money. Today we have a very special interview for you. We've got Austin Stowell, who is a local real estate expert, developer, broker, amongst other things here in the local Austin real estate market. And Travis and Austin have been buddies, I think, for a long time.
20 years?
Yeah, wow, we're getting up there.
Yeah.
Nice. So, a lot of the people that follow the show are investors, traders. We have some people that are in real estate, but real estate for a lot of people is a big part of the portfolio. And we've been getting a lot of questions from, the recent affordability crisis, interest rates going nuts. Austin has been one of the boomiest real estate markets in the nation, as far as I understand it.
Right.
And we've got a bunch of questions. So Trav, you want to just jump into it?
Yeah. Thanks for joining us today, Austin. I think it's really cool to get an on the ground perspective from, one of the hottest housing markets of the last decade. So yeah, first question. What are you seeing out there in the current market in Austin, just in general?
Well, I think it's certainly been rough waters the last 18 months. And anytime you go from interest rates on a 30-year fixed rate that are in the 2s to quickly up to the 7s or even 8 in a very, very short time span. I've never seen rates go up, and no one has at this rate and with such velocity. Yeah, it's bound to have an impact. Yeah, I think that across social media, you're going to see a lot of people that just are harsh on Austin and that it's a crash market or whatever it may be. I'm still very much long Austin as a development and long real estate as an investment strategy. But I think that, we rose really high, really fast. I think there's a lot of speculation. I think we're seeing that in the Airbnb market where everyone kind of speculated rates, whether it's places like Joshua Tree that are like absolutely getting crushed right now in terms of like the average values of those assets are coming down as kind of market demand comes on the back end of COVID, right? So in an interest rate environment that is like exceptionally high. Yeah, across the market, like if you follow, I don't know if you guys follow Lance Lambert's, Twitter feed. He's got a great residential club, I think is his newsletter. But they track national housing standards and prices across the country, and I think that Austin's definitely like not on the top list that we want to be on, right? For the last 10 years, Austin was on every single top 10 list, but right now we're in like some of the top of the country in terms of correction from peak, and then price reductions is probably like we're in the top of those lists, which is not where we want to see.
And it's not really surprising to hear that, because I remember like during and like kind of right after COVID, it was like people were bidding like 6 figures over asking easily on a lot of these houses. So I'm like, dude, if I'm looking at that as like a stock chart, like that's going parabolic. That has to reverse at some point. So it sounds like prices have come back to earth. Do you think that, and I know you can't predict the future, but do you think we're at reasonable values now, or do things still need to pull back a lot more?
Well, I think if you look at kind of like the trend of where we started to go up, so we are down, let's call it 18-20% from peak pricing, right? But at the same time, we had gone up on average 18% a year for the last 12 years, right? So if you had a stock that went down 20%, that's been up 20% a year over year for a decade, would you dump it all? I personally would not. And I think that if you're talking about where do you re-enter, it is difficult. And I think that those that bought during COVID and were competing in those prices, and if you were an investor, it was really difficult to make the numbers work, even though rates were cheap. You're trying to underwrite these things and you're like, I can't really justify coming in and going off. And I think a lot of people that were disciplined in that case, and you have to think too, a lot of people are buying their residence versus just buying investment property, which is different calculus when you're approaching it, right? And even though those people that walked in and paid premium rates, if you're sitting on a 2.875 rate, and even if your property value has come down, most people are going to stick around in a residential property for the average I think is like between 5 and 10 years, depending on your market. So if you're long Austin, I think people will be able to weather that storm.
Yeah.
But I think that just because we see this large reduction across the board in average pricing, every submarket in the city is different, right? So I think we did see some crazy pricing. Like if you would go to some of the suburbs of Austin, it was nuts to see someone on a $300,000 house pay $100,000 over list price. Like that's just bananas.
Yeah.
But and that was happening pretty commonly. Like,
that's happening on like your KB Homes of the world.
Yeah, I mean,
it was happening.
Well, I mean, you had builders that were out there that were literally just terminating contracts because they could resell, and just were hoping that the buyers wouldn't sue them. And that was not an uncommon practice to just literally have people that were in deals for 6-9 months terminate their deal and then sell to the highest bidder.
Yeah,
and so it's funny to watch kind of the reversion back to a normal business practice, and everyone's kind of operating as they should in the sense of like honoring those original contracts. And now we're back to where builders are offering huge incentives to try and get people in the door.
What's your sense for like the current mix between, of the transactions that are happening? How much of the demand is for, investment properties versus it's someone's primary residence? What's your
in terms of right now?
Yeah.
Like who the typical like buyer class is?
Yeah, and I actually would be curious to hear what that mix looked like 2 years ago and what that mix looks like now.
I mean, we were overflooded with investors for sure. I mean, everyone was trying to ride the train of Austin, as it seemed to go up endlessly. I think that right now, what I've seen is all of the speculation has completely gone away. There's still disciplined investors that are out there buying. I work a lot in the infill development world in terms of new construction in mostly central Austin. It had gotten to the point where places like Zilker, where you used to live, lot prices alone, just for lots, were going well over $1 million. And they were bidding wars. And I've seen lots traded up to $1.4 million. Now, those same lots that were trading at $1.4 million are trading at like $800,000 to $1 million.
I'm guessing that's like a 8,000 square foot lot or so?
If that, more probably like between 6 and 8.
Wow.
Yeah. So, I mean, so you see a huge change. Now, certain developers and very savvy investors that have been able to weather the storm, they're still out there buying, but again, they're buying at that lower rate. We do have a massive amount of inventory when it comes to, I say luxury with quotations, because there's a lot of people that have gotten away with building a mediocre product and being able to sell it for a premium price. And now that there's quite a bit of supply, the only way to really get across the finish line and actually get a buyer is to actually have delivered a quality product. But those decisions were made 18 and 24 months in retrospect. And so it's really difficult for a lot of these developers that are sitting on inventory to actually get their product to move.
Mm. And so if you put on your investor hat, what types of deals do you typically look for? Are you in residential, commercial?
I mostly focus on residential. There's the commercial world in Austin is very interesting, but obviously comes at a much higher price point. Yeah, I tend to focus more on base hits than home runs. And so you can win a lot of World Series on base hits.
Yeah.
Do you have a target IRR or annual return?
I mean, I think if you look at most disciplined investors, they're going to be looking at IRRs between they prefer to see north of 15. At the end of the day, really, if I can't, I'm too dangerous. I wouldn't even trust myself with a spreadsheet. I've got very rudimentary knowledge when it comes to the financial side of things. I think it depends on the specific deal side. I mean, if you look at like a typical flip we do, and a lot of other folks I know that do renovations, they typically won't look at deals unless they can make, let's say, because just the amount of staff overhead it takes, like $50,000 to $100,000 per turn, right? And so that, again, that depends on the price point, and that would go up obviously as the price point goes up. But I think the sweet spot in Austin for renovating houses is to try and kind of deliver what the mass market wants, which is your typical 3-bedroom, 2-bath, between 1,500 and 2,500 square feet is kind of like where I think my personal sweet spot is.
Gotcha. And do you focus on fix and flips, or do you hold as a landlord?
I focus on so we've got quite a few rental properties. I've bought properties, I think I bought my first property in 2007, and we've collected them over the years. And I tend to focus a lot on like duplexes. Buy and hold duplexes is like my preferred method for buy and hold. I kind of see them as an attractive covered land play. You can have rental income over the years. Property tax in Austin is no joke, and something that I think every investor needs to really think about, that I see a lot of people not really properly underwrite when they're going through and looking at investment properties. In Texas, obviously, we don't have an income tax here. And so your typical property tax rate can go, depending on where you're buying, anywhere from like 1.8% annually of the property value up, if you buy in places that have a MUD, up to over 3%. And so when you're trying to calculate your rental income, that can make a huge clip, especially if you're buying something that's been relatively undertaxed, and then the county catches wind of that valuation, and the next thing you know, all your profit margin goes away.
Yeah. Have you run into any Californians that moved here thinking they were going to save money, and then they like
every day
look at their property tax and they're like, what the hell, $100,000 a year for taxes?
Oh, especially in the luxury market, right? Like, I mean, you see, a $5 million house can easily carry a $100,000 plus property tax bill, and a lot of people don't anticipate that.
They just hear zero income tax. They don't think like, oh man, I'm going to pay that property tax every year, and that's only going one direction for the most part.
For sure, and it rarely ever goes down.
Yeah.
That's crazy. It's a challenging thing that I think a lot of people have to come to grips with when they're buying.
Yeah. I'm always impressed by people that can do flips profitably, because I've tried it a couple times, and every time I touch real estate, it loses money.
Right. It's a challenging deal. And I think it's tough too, because you have to remember, especially when money was cheap, the competition was just trying to find the cheapest possible way to continue to do it, and you could get away again selling a mediocre product. And so if you're trying to actually do things right and actually take care of some of the stuff that you don't necessarily see that isn't sexy, like new roofing, new electrical, actually properly doing these things, waterproofing, windows, etc. Like, a lot of people were really doing some pretty poor work, poor craftsmanship that was getting sold, and so it was just lipstick on a pig, and that was what we saw a lot of, and I've seen quite a few of them over the years. And we try to distinguish ourselves, because when the market does go down, if you have a quality product, it's still going to be easier to sell.
When you do a rehab project, do you tend to get better returns from something that you have to sink more capital into? I've always been curious if there's a premium on projects where you actually have to put a significant amount of capital in, because there are a lot of developers who are, or investors who are trying to look for the quick gains, where they go in and they redo the kitchen to make it look a little nicer, but they're trying to do a quick flip, versus someone who actually spends. I know you've spent some significant time and capital on a few of your properties to make them.
Yeah, we're doing like a 6,000 square foot remodel right now that is an absolute money pit. But I mean, it's compared to other projects in terms of just like actual cash capital allocation, and a project of that scale is oftentimes difficult to underwrite on the front end, to be able to like structure the capital so you can fund that remodel with cash, or you can figure out a way to do a loan. But if you're going to go through banks, or even if you're trying to use something like hard money, everyone's going to still want to see a full pro forma, versus if we're experienced enough to where we know kind of the general cost of these things. But yeah, you can absolutely make quite a bit more money doing that. But I think that higher risk, high reward, right? So, and there's also the the mental headache of just kind of having that much cash allocated in a single investment, and then again you have to be committed to it until it's done. Whereas the one we're working on right now, we'll be into it for 2.5 years by the time we're done.
Wow.
So that's much more of a commitment, versus like, I think the fastest flip we've ever done is 84 days.
Oh wow.
So then that's in and out. Yeah.
So how did you get into real estate? Did you go to school for that, or?
No, I actually was a pharmacist before this.
Really?
I was a pharmacist at Target. Yeah.
And how'd you get into real estate?
So I kind of grew up in the business. My dad owned multifamily, kind of like Class C multifamily, but he prided himself on providing affordable housing options, and he did in areas of town that are super popular now, but were not popular back when he owned them. And so I've been changing locks since I was like 5 years old, and it's always weird to me, because I think I always see real estate as an investment vehicle, even if it's my primary residence, because I'm always willing to move. And so that's kind of always been my perspective. And being a realtor over the years and recognizing, that's oftentimes the majority of people's, that's not their primary goal, right? Yeah. And so trying to be empathetic to that, but also help people recognize that opportunity. But it's it's been just kind of a journey to try and go through that, and transitioning from being a pharmacist into doing real estate. I got sick of honestly just being trapped in the pharmacy world.
Yeah, being in the same little, it's like working bright light room all day.
Yeah, it's like being in Vegas. There's no windows, right?
Yeah.
So I was looking for an opportunity to get out, and I had always done it through college, just as kind of a part-time gig.
Like being a realtor?
I was just doing brokerage stuff.
Okay.
And so I'd work part-time, and I had a pretty sweet gig in the pharmacy world, where I would work 1 12-hour shift a week, and every other Friday, Saturday, Sunday. So I had time to both work with clients as well as work on investments. And then I also had W-2 income, which helped. It's difficult to get opportunities in the finance world with pure 1099 money.
Right.
And so it was a great opportunity to kind of like blend those two, from having commission income, having a regular income, which is banks love to see, and then leveraging that into rental properties, and then turning those over, 1031ing, and doing additional investments down the road.
How did you learn the business? Obviously, there's some licensing requirements in a state like Texas where you do some education, but how did you actually learn what mattered or really
trial and error?
Yeah.
Trial and error was mostly, yeah.
Did you make money on your first deal?
Yeah. The first house I ever bought was 2007. It was kind of a burr live and flip type thing. We paid $135,000 for it, and then we sold it 2 years later once we hit the 2-year mark, so you don't have to pay income tax on those gains. Sold, I think, for $215,000, and immediately bought a house down the street, and then that's what kind of started the journey. We did that renovation on our own, like literally like hand painting the walls and swapping cabinets out ourselves and stuff like that.
Cool. Yeah, I mean, I think that's a great thing for like young folks, right? Like move into something cheap, put some sweat equity into it,
right?
That capital, roll it up.
It's a great opportunity. I think once you actually know how hard things are to do, you can kind of figure out what's worth to do it yourself, what's worth it to invest in having someone else do it.
Yeah. Speaking of having someone else do it, like how is the talent pool in Austin, and like are there workers available, or is it hyper competitive? Or
it's hyper competitive. Like I think especially during when the market was going crazy, right? It was very, very competitive to get quality trades. Mm-hmm. But yeah, Austin has a great resource of everything from your typical standard trades, whether it's drywalls or painters, and then there's every level you can imagine. And then we have some incredible craftsmen when it comes to like the super high end cabinetry and super high end trim work, steel workers, et cetera. I think we're really lucky here, and I think we have a broad group, and having done it over the years too. Yeah, I kind of hacked my way into my first new construction build and learned everything I could in that process from my builder at the time, who's still a friend, and then have done several more with builders, and now we're doing our own projects and kind of learned through that process on how to do it on our own.
What's the biggest challenge when it comes to new developments in Austin?
With City of Austin itself, the government in the City of Austin and how it kind of operates.
Red tape or?
Yeah, we have a lot of red tape, and oftentimes the left hand doesn't know what the right hand's doing. I think it's all well-intentioned, but we have 20 plus years of kind of tweaking the code to satisfy small factions in Austin, and it's created this really mired complex workplace. There's a lot of builders I know that won't even build in the City of Austin. They specifically will only go to other communities outside of Austin, like Dripping Springs.
Really? What's the challenge? Is it just like getting permitting, or?
I think it depends on the project and like what kind of developer you are and what project. So we have when it comes to big commercial development, you have all sorts of issues when it comes to things like compatibility, and that's one of the things that's being discussed. You can be zoned, for example, let's say you're on East 7th Street, and you can be zoned to 60 feet in height. But if there's a residence behind you, you have to be tiered in some level between here and there. But that lot that was designed to try and create a gradient to adjacent properties. But the goal when they zoned it was to get it to that height. But then you have this middle code that is not in the zoning per se, that's trying to satisfy that need for a gradient. But really what it does is it ultimately nullifies the intent of that original goal. And then when it comes to single family housing, there's just, it's incredibly complicated in terms of, how these things are set up, and that, we can get into that in detail, but it's more of like, you want to try and build, you go to other cities in the country, and it's amazing because you can just easily go and be like, okay, I have a lot, I'm going to build 2 or 3 units on it. I can build this total square footage, but the City of Austin has very complicated rules. So you can only build something this size. They have to be this far apart, this driveway. We're only going to allow one driveway. There's 100 different rules that go into it, which actually provides a huge advantage if you know how to navigate those rules to those of us that are local, because I've had developers that have come in here and then they walk away and they're like, oh my gosh, how do you deal?
Yeah.
Like, how do we make the numbers work?
So it's interesting. You mentioned, that you mentioned a couple times now that, obviously real estate, there's that saying, real estate's local. And
right.
It does seem like there is a lot of really great local expertise that you build in a market that can make a big difference. But have you ever thought about going to greener pastures or doing deals outside of Austin? How do you think about that?
I've thought about it. I mean, one of the markets that's most interesting to me outside of Austin right now is Lockhart. It's absolutely booming. Tons of artists have moved down there. There's a lot of tradesmen have moved down there. A lot of the talent that works in the construction industry tends to live, south and southeast. And so it's interesting to have kind of watched that sub-market boom. And I think we're going to see other sub-markets boom as, rising boat is lifted. What's the phrase?
Rising
tide lifts all boats.
Yeah.
Thank you.
Yeah.
And I think it's a situation where as Austin was growing, other communities outside of Austin were going to continue to be the beneficiary of that. And I think that, obviously we've been kicked in the teeth over this last 18 months, but if you look at places like Lockhart, it's continued to grow.
Interesting.
Yeah, it seems like the whole like Texas triangle is just attracting people from New York, California. Are you still seeing the flood of people, or has that kind of slowed down?
I wouldn't say it's much of it. I mean, it's still, it's not nearly the same in terms of when you say like a flood, but the nozzle isn't off for sure. There's still plenty of people that are coming here. Yeah, I think if you look at and underwrite a city, then ultimately what attracts people, and if I was talking to Mark Sprague, who's a local economist, I mean, education drives everything, right? And so we have the University of Texas. We have Army Central Command has set up their kind of tech center in Austin. You have tons of people that have come in with the University of Texas Medical School that came in about 10 years ago, and folks in the biotech industry, and kind of the conversion of biotech with government contracts and everything. And so like Austin's still a hub for a very diverse economy. Mm-hmm. And I think that when you add that diversity of an economy with a highly educated workforce, that's a recipe for a good long-term investment strategy for a city. And so that's why I'm long Austin. I mean, I tend to think that you can have the fuel caused by COVID, cheap interest rates, money being pumped into the system, and then the desire for speculation that have really caused this huge increase. But I think if you're looking particularly in the central city of Austin, though I think rates have caused a slight depression in values, I don't necessarily think that that's going to continue long term.
Yeah. So I was actually in the mortgage business during the last housing boom in the early 2000s. And one thing that I saw firsthand was just like speculative building. So it was like oversupply and just speculation in Austin. And just over like the past few years, it seems like there's a dramatic undersupply and huge demand. And then like rates went up. And so it was like nobody wanted to sell. Nobody could really afford to buy. So it's like a locked market. But the thing in Austin is like people are actually here. It's not like as far as I can see, like speculative building. Would you say there's still like an undersupply, or has that caught up with demand?
I think it depends on the price point is the biggest thing that I've noticed. When rates are cheap and money is just flowing over the boat, right? You had so many people that were coming through, and the biggest growth factor in Austin was the luxury. Everyone would get into the luxury space. And so and that's the reason why we see kind of this glut of $1 million+ properties, right? It also is because our code kind of rewarded that, in the sense the idea is it's really complicated to build multiple units on a lot. Right. There's a lot of red tape that you have to go through, but the math is really easy when you're building one big single family house. Mm-hmm. And that has caused to have this large oversupply of luxury properties, but there's not a lot of supply when it comes to, let's say, 500,000 to $1 million. Yeah. Right. And obviously affordability is, it's based on your perspective and in your specific market. Some people will say that that's not affordable, right? But if you're coming from California, 600,000 looks pretty good, right? Right. And so, particularly if you're in a great location and schools, et cetera. So I think what's happened is that we have this really high supply of luxury product, and what the city's trying to respond to, and what they just have done, is they've passed the home initiative, which is going to change the way development happens in the city of Austin. The code was voted on, I think, in November and just got instituted in February. And what's going to end up happening now is I think that they're going to allow in this first phase 3 units per lot. And you're not limited on how big that unit is. You can get a total, and it almost incentivizes building 3 units because you get to build more total square footage if you're building more dwellings or more homes. And it disincentivizes giant luxury homes because you still have to abide by the old rules if you're only building one house. And so that's the interesting thing that's going to happen over the next few years, is I think we're going to see this transcendence, or getting away from large luxury single family homes and more for smaller unique units. And I think that depends on the submarket in the city of Austin. But what it is it's giving builders, developers, and investors options that didn't exist previously.
So it's going to offer more maybe affordable housing and more density.
Correct. Yeah, I think it's more about options on what you can build, right? So like if you want to build 3 1,500 square foot houses, that was an impossibility previously. And you could only build one 4,500 square foot house. Now you kind of had, or let's say 3,500, but now they'll let you build a total of 4,500 square feet depending on the site size. But again, you can build multiple units as opposed to just one.
Hopefully that'll be good for, like the lower end of the market. And I guess like, if you are looking to buy a house in Austin, are you going to get a better deal on like the $1 to $3 million price range, or where's like the best value right now?
I mean, I would say, yeah, that is probably, there's more inventory than I've ever seen in that price point, particularly like in zip codes like 78704. And so we have, I think, multiple years worth of inventory at that price point.
Oh, wow.
Yeah. In terms of just like, a lot of these luxury products. And again, it comes down to finish outs. I think people that really invested in design and a lot of high end stuff are still able to sell it to that market. But a lot of people, I think, were generally going to be in a lower price point and we're stretching because rates were cheap, and there was definitely not enough supply to respond to that demand, and now that demand has almost evaporated for, let's say, a kind of a B plus product, and now there's quite a bit of that exists in the marketplace, unfortunately.
Gotcha.
We on this show, we obviously talk a lot about the Fed and interest rates and how much the Fed is screwing things up. But do you see like a big difference in how the market reacts or how demand reacts if we get, say, the 10-year yield moving down from 5% at peak last fall to at one point I think it was at 3.8 a couple weeks ago. Now it's a little bit higher, but if we do get cuts later this year and we get the 10-year down from where it is now to a couple percentage points lower, do you think that like unlocks more demand again? Do you see like a big return to kind of a booming market again?
What do y'all call it? Like the V-shaped bounce or whatever?
Yeah.
I don't necessarily see that's going to happen.
Yeah.
I think it's going to be kind of a slow crawl back over the next 12 months. And I think we're going to get some velocity after that.
Yeah.
We're definitely seeing just anecdotally in the market working with buyers. Buyers are coming out finally. Mm-hmm. I think the last 12 months, most people have just kind of, now's not the time for various reasons. Obviously, interest rates are part of it. I think there's consumer confidence was totally shaken by everything. And now that we kind of see, and it's not necessarily like people are still buying houses still in like, let's say with 6 and 7% rates, and they're happy with it. I wouldn't say thrilled, but at the end of the day, they're able to buy something that they previously, may have missed the market. Prices have come down. They're able to make the math work based on their own personal finances, whether it's an investment or personal residence. But there's some optimism for the first time that I've seen in a long time, both from investors and single family home buyers. And I think a lot of sellers have kind of come to grips and things have leveled out, but we're definitely seeing some improvement in the local market.
It would be nice to have a more normalized market rather than these like boom bust cycles.
Yeah, it's stressful on both ends of it. I mean, when you're working with a buyer, you show up to a house and there's 15 people in line, and it's like, there's a deadline, the listing agent doesn't pick up. That's where actually relationships are great in this market, is you can try and find things that are off market. It was helpful both then and now, but to try and find unique opportunities. But it's definitely been stressful on both ends of it.
Yeah, that makes sense. I mean, one of the things that I saw a lot over the last couple of years, I don't know how much this is happening. I'd be curious to get your thoughts, like this Grant Cardone style personalities that are on TikTok, or even like young kids on TikTok talking about, taking out credit cards to like buy their first property, and then, getting rental income from that, and then levering that rental income with another bank loan, and then levering that next property with another bank loan, and like just sort of like getting these like massively leveraged portfolios of real estate. Do you see much of that in the market now?
I wouldn't suggest it. I think a more disciplined approach is definitely the way to do it. I don't have a whole lot of faith in the real estate influencers, or a lot of them in the social media world. Real estate is and should be boring when it comes to investment purely. I mean, I think if you do want to do some of these, like a lot of people like to do the flips because they're into design too. It's also kind of a creative outlet, and there's ways to make money doing that. I think markets like Austin are really challenging. Like high property tax areas are challenging. If you're just going to buy something, renovate it and rent it. I've done that myself. We've sold off several assets in our portfolio this last couple of years, because it's like, by the time the property tax catches up to full market values, you throw that into your pro forma. And I started doing, calculations on some of my stuff. And I think, on my net equity, even in a down market, I was making maybe a 2 cap. Ooh. And it's like, why do I own this? I mean, it was mostly because property tax had gotten to the point where it was exceeding my mortgage on some of these, so like, that's, I've owned these things for 10 plus years. So I think that's the challenge. I mean, being a typical cash flow rental investor, whether it's California, Austin, there's like a lot of these like, top, what I would consider top tier markets are really challenging to make money. I mean, that's why other, submarkets are a much better investment strategy when it comes to just pure rental income. I think the investment strategy in Austin is a little bit like nuanced in the sense of like, how do I add value? How can I add more rental units, right? And how can I figure out what I can do that someone else can't figure out how to do? And, trying to figure out that niche knowledge, I think, is how you really try and find ways. Or, if you do have something, it's like, okay, eventually I'm going to go and build a development on this, but in the meantime, I can get cash flow, but it gives me time to plan, you figure out my capital stack to make this make sense, rezone something. Those types of options are a great way to try and extract value out of an asset.
Nice.
I think finding a competitive edge, no matter what asset class you're in, is always a key to making better than market returns.
Yeah.
Right.
One thing I've noticed in Austin is like they just keep building skyscrapers.
Yeah.
And I look at it and I'm like, okay, the apartments and the condos are good, but it seems like they're still building office space. I don't know how much you know about the commercial side of things, but one looming kind of black swan that people are thinking about is the commercial real estate market.
Oh, yeah.
Some people forecasting that it's going to bring down the entire system and we're going to have another GFC like in 2008. Do you have any opinions on that?
Yeah, I mean, I think it makes a lot of people nervous, and rightly so. I mean, unlike residential loans, commercial loans rotate, right? So like they typically are 5, 7, 10-year terms, right? So, and then you also run into a market where people are having to recapitalize. In a market where values have I saw one building in San Francisco the other day that's trading at below the construction note, right? Like in terms, so like that's kind of terrifying.
Yeah.
I think that there are a lot of people that are having to go, but the lenders don't want the keys back either, right? So a lot of people are trying to figure out ways to like renegotiate these loan terms. But I think the office space is going to be really challenging. I think multifamily is going to be really challenging and continue to be so. Austin also. I forgot. We're one of the top units in the country in terms of units in process being in like set for delivery.
Yeah.
And so that's
like
going to
commercial or real estate.
Specifically on multifamily.
Yeah.
Oh, okay.
The apartments,
like all the condo buildings going up.
Specifically, I mean, it's not necessarily going to be the high rises downtown. Those are obviously included in the total. But if you think about where most of the multifamily is being developed, it's everything from Kyle to Pflugerville, right? And so like you've got tons of multifamily being developed on major corridors where they're incentivized to develop these things, or where the code incentivizes that to be developed. And we have tons of units coming on, and how that impacts a market where people were paying premiums and buying these things on 3 caps to figure out, because people were flooded into the multifamily space and people were glad to pay that, which is crazy to me. But then now you have this new situation where it's like you have all this inventory that's going to come in, further compress rental values, and then people have to go and recapitalize all of a sudden with their books where they thought they were expecting 7% rent growth every year, and all of a sudden now it's 20% below, or who knows where those are going to play out in that comparison. Which is why multifamily, there's a lot of money in the multifamily space. Which is why like I personally, invest in smaller assets like duplexes and stuff like that. So it's a different investment strategy, but I think that, the multifamily market's definitely going to be compressed. I think the office market is already suffering greatly across the country, and Austin's no exception.
I wonder what the end game there is. It like converting to condos? Is that even viable? Or
I mean, it is. I think there's a lot of complexities associated. Most multifamily buildings are not necessarily built to the specs that you would build on a condo. So I think a conversion is also going to be challenging. I think it's just going to end up trading hands at a discount is what some of these things, if it comes to that. But we'll see how long our current interest rate market, because a lot of people can survive stormy weather. I think it just comes down to timing for a lot of folks.
Yeah.
But it is concerning when you have a lot of debt all cycling through this at the same time and having to recap.
Yeah.
So,
do you ever invest in other people's projects or other people's real estate investment funds?
Yeah.
How do you think about that versus, your own projects and capital?
I think for me, it comes down to, it's not necessarily like a specific pref that I'm chasing. It's more of trusting the GP on those. And I think that's the biggest advice I can give to any investors. Like, I think you really want to understand the numbers, but at the same time, you need to understand the operator, understand their experience. And at the end of the day, you have to trust someone being a steward of your money.
Yeah.
Because there's a lot of fraud that goes in the real estate development world. And there's, you can tell a lot of lies on a spreadsheet.
Well
so
said.
I spend most of my day like in the crypto world, which we have our own whole group of scammers and frauds in there. But like real estate, in a way, makes those people look like angels. Like in my experience, like I've just run into some really fraudulent people in real estate, and like, yeah, like how do you vet somebody, or how does somebody who's not a real estate professional invest in a fund and have confidence that they're not going to get fleeced? Like any red flags to look for, or terms that you typically like to look for, or types of real estate that you'll stay away from?
I think, any, GP investment that's like mostly fee-based, right? I think it's a disincentive, right? And so the idea is like there needs to be aligned incentives. You can't just be like you're getting acquisition fees and management fees and all these other things. Like what are the paramounts that are going to be in that deal?
So the general partner, you'd want to see them putting in some significant equity.
Yeah, I mean, that would be a perfect scenario. I mean, that's not necessarily a requirement. It's always great when people are doing that, but a lot of times people are raising funds, investing their own funds. But I've raised a small fund myself on a 15-unit development, and didn't invest in it, but it was all sweat equity. But again, it's all about like those positive relationships and making sure. And I didn't take any fees on the front end of that deal, so it's like everything was on the back end, so there really was no risk to the investor. But I think that that's difficult for typical funds to operate, because you still have overhead, right? So you need to be able to like pay yourself, and you don't want to be trying to rush to get a deal done just because you haven't been paid in 2 years, right? So I think there's a balance there, but I think you just kind of need to focus. And some of my investors that are quite wealthy, that's one of the things that they've always watched out for, and something that I would be consistent with is you don't want to be overfeed.
Yeah.
I've looked at some deals, and it's like they're going to charge 1% to buy, 1% to sell, 1% to manage, and then I don't know. It's like, well, wow, that got really expensive really quick.
Yeah, I saw one the other day where it was like someone on Twitter was complaining about a GPLP structure where it was like the I think it was a dentist or somebody that was investing in the deal, and it had been presented and asked a real estate friend, like, is this fair? And it was something along the lines where it's like, the investor takes 100% of the risk. Once the equity is returned, then the GP gets 70% of it, and then just leaves 30% to the LP. And that was the math. There was no like IRR, Paramount, or waterfall or anything like that. And he was like, so you have to watch out, because people that don't understand how typical real estate deals are structured can absolutely get raked over the leaves. And so I think it's important for people to, Twitter's your best friend. There's some really great assets of investors on Twitter to follow that can have done some really in-depth breakdowns of deals. And I think that that's a great resource.
Oh yeah. That's a great place to learn.
But I think it all depends on how much money you're investing. I think if you're a typical investor that if you're not going to get into these funds and like invest 25 grand, right? Like you're probably better off at that point trying to figure out how to buy a rental property, do a renovation, something like that, versus like, I think as you get into these bigger funds, like any other investment, you have to be willing to take a loss on it too. And I think that's what some people are seeing in this market too, is that things have turned on a lot of people. And so there's a lot of people.
Saw a big infill developer here in Austin go under late last year.
Yeah, one of our most famous ones. Yeah. Yep. That was, 2 years ago, they were the talk of the town.
Yep.
So it's a, debt is going back to what you were talking about earlier. It's like leverage. It's a scary situation in which, if you're not wielding that weapon correctly.
Yeah. What levels of leverage are you comfortable taking on your own projects? How do you think about that?
I think it just depends on the specific deal. I mean, I think, in terms of like, are you asking like specific deal size or like?
Yeah, just, a typical homeowner or someone who buys, their primary residence is going to take, 80% of the value of the house via a bank loan and then 20% down. That's like your standard. So essentially what that means is you're like 4-to-1 levered on your equity.
Right.
But I know that some developers will then add, they may get a bank loan for 70 or 80% of the value, but then they'll add what you call, hard money loans on top, which tends to be, debt that's at a 12 to 15% interest rate,
right?
Maybe for a shorter period of time, for a couple of years. But that may take them to 90, 95, even 98%, debt versus equity.
Right. I think it really depends. Every deal is super specific, and I think it's based on kind of the timeline. A permitted remodel in the city of Austin can easily take you a year. So like, do you want to take on a risk like that. My preferred method on doing these things is to get a traditional bank loan and then go through and I'll do like a typical 80-20 split on debt. And then I'll usually fund the remodel with cash. That's my preferred and very milquetoast simple investment strategy. Not very sexy. Other people are able to go through and take that same amount of money that I've invested and take on 5 projects in which they're doing like a 95/5 loan with a hard money lender. But then you have to start thinking about what's my cash flow? What happens if the deal takes longer? How long? What are my returns on the back end of that deal? There's a lot more math that has to go into it. You can absolutely make a lot more money, but again, I can also bet my life savings on black.
Yeah. Risk versus reward.
Yes, I think it's just every investor is going to have their own, desire for return and balancing it with their ability and desire to take on risk. And I tend to just be a little bit more, calm when I'm taking on some of these investments and, willing to sell off some of them to fund other projects. But I tend to not get over levered.
Yeah. Have you ever had a deal where you had to give the keys back to the bank?
Luckily, no. Luckily, no.
That's good.
And I think that's the idea is like, I like to be in the money, like from the day we close on anything. Right. And the idea is like, if I, obviously it becomes harder to sell something once you're like, halfway into it, like if you've got demo already done, but it's always great to walk into a deal on day one and be like, I changed my mind. You can sell it, make a small clip. Right. And I think that's how most investors should look at anything. It's like, if something changes in that short term, you can still make money by selling it to someone else that's willing to take the project to the end. You're not going to make near as much money, but I think that's a much safer strategy. It also builds in that margin. And because there's a lot of margin for error, especially when you're doing single family renovations, you never know what you're going to find when you start opening up walls.
There's so many variables, man. Right.
Yeah.
So I was doing a rehab in Temple, which for anybody that doesn't know is what, like an hour north of here.
Yeah.
And, we budgeted like 20 or 30K. Next thing I know, I'm like 100K into the deal. I'm like, man, just like so many variables, so many things can go wrong. And like you said, as you get into a rehab, it's like you just discover more and more and more. Do you enjoy that part of the business, like the rehab and like dealing with contractors?
Yeah, I started off school in architecture school. I couldn't draw for shit, so I had to figure out how to work that. And so but I do like the design side, and we've done a couple new builds early in my career, and so I really liked that design process. I also liked kind of the process of taking something that's ugly and making it great, right? Like, so that is an enjoyable process. I think in terms of like kind of developing your unfair advantage and taking some of those variables out of it, one of the ways to do it is kind of get comfortable with a typical flow, right? So the idea is like, okay, find an area that's predictable, right? Find a product that's predictable in terms of acquisition and sale. So like, again, going back to what I said earlier, is like a typical easy to sell product is a 3-bedroom, 2-bath with a 2-car garage, over 1,500 square feet. I tend to not look at anything less than that. And so, but when you find these areas of town that you're comfortable with, kind of the risk factor. Okay, the soils over here are terrible. It's going to be really difficult to, you don't want to buy in this specific area because they tend to have foundation problems. Or this house, these were all built in the 60s, and I know that this specific area all has cast iron pipes, and it's going to cost me $50,000 a house to fix the foundation and the plumbing before I even get to the stuff that is pretty unattractive. So you can still take on those projects as long as you know what that risk factor is. But when you're developing in Texas and you're digging down, if you've ever seen someone take out cast iron pipes, it's a mess. They literally have to dig down 6 feet. They're digging and tunneling underneath the house, fixing it, and then filling it all back in. And that causes delays. It's very expensive. It's typically paid on a per linear foot basis. And so like, if you know these risk factors, you can kind of look at a project, the first one's complicated, but then all of a sudden your fifth one, you're like, this is very, predictable. And so I think that like that is a great way to, if you want to do this or do this particular type of investment, kind of developing expertise in a micro area is a great way to do that.
Smart.
It takes out the risk, right? There's always going to be risk, but I think the complete unknowns, the things that slap you in the face, tend to be less significant.
So just get to know a specific area really, really well.
Yeah. I think that's the key. And whether you're, if you're an investor, obviously, I think a great real estate agent, which not all real estate agents are great, but there are tons of good ones in Austin. And I think that like those agents can be really great resources, both from contractors to like how to get them, contractors that are available, contractors that will show up, contractors that won't walk away with your money. Those are great resources in terms of being able, and then also like knowledge on areas. Those of us that sell a lot of houses, you tend to take buyers in them. You've inspected them. You've seen 5 to 6 inspections in a certain area. You're like, this area you don't want to buy. You know what I mean? Like, so like those are great ways to kind of guide you through those submarkets.
It's an interesting point. The value of an agent still can be extremely high, especially for someone, making the biggest purchase of their life.
Right.
Yet we still hear, a lot of pushback, whether it's Twitter or just generally about, the 6% commission or the 6% fee that agents take off a transaction, off a typical transaction. There's been a lot of talk over the years about that going away or that getting competed down, or providers like Opendoor coming and competing that down somehow. How do you think about that? How do you think about the 6% commission? Do you see it staying at that level? How do you think about that?
I think it depends on the submarket. I mean, I think other markets like California, you've already seen a compression, but it also, when the typical sales prices in certain markets is starting at $3 million, the conversation about percentage, becomes a different deal. I think as technology advances and as, I think information becomes more ubiquitous and people have access to it, I think it's going to become incumbent upon agents to provide value. And I think that like any transaction, as long as there's value between buyer and seller, or like the person utilizing the services and the person dispensing those services, then it's an efficient market, right? And I think that we have, with the advent of information being available everywhere, and anybody can look things up on Zillow, but that's always the thing I hear about. It's like, well, I can just do it on Zillow. It's like, I can find, there's a huge percentage of the market in Austin that trades off market. And one of the reasons is that the county never sees that sales price. And this is even more efficient or more important when you start talking about the ultra high end luxury world, in which properties are trading 20, 30, 40, $50 million. No one wants that tax bill, right? And it's very difficult for the county to try and assess these values. And each property is so unique, and they have the counties have a tendency to kind of blanket appraise these things. But I think that's one of the values that agents provide, whether it's at that price point. But there's also investor properties, and then there's submarket. The like submarket knowledge on where development can be allowed, where it isn't allowed, these other micro rules that happen. And I think in each agent of their submarket needs to become an expert in their submarket when it comes to these things, to try and find niche ways to provide values for clients as things are getting more competitive for agents. I think iBuyers have a place in the market. The Opendoor stock is taking it in the teeth, and Zillow lost I think a small country's net worth.
They got out of iBuying.
Yeah, they got out of iBuying, and I think that's a challenging market. And that's a unique circumstance, right? Because everyone's trying to compete in the tech world to get to the top and be the one. Also in an interest rate environment where rates are too, and then they're competing with the same buyers that are over there paying $100,000 over a piece. I think they've survived it. And I think that we're going to see some interesting spaces for them. I'm long term. I think that there's a spot for iBuyers in the market. I think you have houses that are indistinguishable from each other in certain suburbs across the country, where every house is a 4-bedroom, 3-bath that's 2,500 square feet, and they all look the same. Yeah, I think that's not a bad market. But at the same time, if you look at the fee structure of iBuyers, they still charge a pretty solid fee, right? And they have to, and then they're also going to pay less than what is typically market value, because they have to go in, fix it up, make a spread, cover that debt carry in the interim, and then still pay someone on the back end. So like, are you saving anything?
Not really. Yeah, I think Opendoor.
For anybody that doesn't know what iBuyer, how that works, like what's the 30,000 foot overview of that?
So, I mean, typically, like you go to opendoor.com, you enter your address, and they only buy they've become more disciplined in the type of product they're going to buy, but they'll using their algorithms determine a value, and then they can literally, they'll go and inspect the property just to make sure, but they can provide you cash in a very short period of time. And there's some benefits of that, right? I mean, that's always been the argument of what wholesalers are, right? Is that they're going to provide quick cash close. Ultimately, those people are going to be selling your contract to other investors and making a spread. And I much prefer someone like Opendoor, because I think that their algorithm is more beneficial to the homeowner. Oftentimes, wholesaling is a different world, and there's a lot of misrepresentation, I think, in that world, and the opportunity to take advantage of the consumer. And I don't think it's a lot of people, I think, leave a lot of money on the table when they're dealing with these urgent situations.
Yeah.
But they're also, again, the wholesaler, there's a spot for wholesalers because some properties are in such bad condition, Opendoor can't go in and buy them.
Yeah.
Mm-hmm.
So there's always a market for it. But I still think like exposing it to the market is going to be like your best bet for a consumer. But I do think for your typical move-in ready type house in like greenfield development, like that's a spot for Opendoor. I think that, there'll be a spot for them, and I don't know where it's going to work out long term, but I think there's a spot for, a lot of times people view it as a binary, right? It's like, okay, it's either going to be all become, algorithmic buyers, but housing is really difficult, right? Like when you get into certain submarkets and certain neighborhoods and schools, and if you think about, you've got a kid coming, right? Like so you start thinking about what you want for your kid, and like, okay, where do I want them to go to school? Like, what is it like? How do you get like a deep dive and actually find a relationship with someone in a market? And like, what is this school like, and what is it like at the PTA meeting, and what is it like for this, and where's the nearest park, and like, what's it like to specifically live in a neighborhood? And then you go into neighborhoods where I live over in Zilker. Every house is different, and like so, like where what is it worth it to pay? And you have spectrums of price per foot going anywhere from $380 a foot to $1,500 a foot, and like what determines
in the same
that
zip code,
in the
right?
same zip code?
Yeah.
It's like that's really difficult for an algorithm to figure out.
Yeah, I've spent quite a lot of time actually looking at Opendoor as because it's a publicly traded stock, and it's been in quite a roller coaster over the past 3-4 years since it IPO'd, and they obviously got caught out 2 years ago when they bought too many homes at the top of the market. They've been slowly selling a lot of those homes for a loss. But you're right. In certain places, I think about where I grew up in the suburbs of Houston. It was like cookie cutter homes. Like, why wouldn't the algorithm be able to make an offer on a home that's relatively efficient and, make that transaction really seamless for the seller, that they could close with a cash close within 30 days. That I think makes a lot of sense. I think that's probably also why they do so well in a place like Phoenix or Atlanta. Right. But you're right. There are, we've worked together on a property sale where it was, something where like, you got to factor in the HOA, you got to factor in all these other things. And like, can Opendoor really capture all the little subtleties of a local real estate market? And it doesn't seem, and the results haven't shown that they're able to do that, for the entire real estate market. But it is a very big market. I mean, the real estate TAM, even on an annual basis, is in the trillions. And so if they can survive long enough, they're still burning cash, but they're improving their profitability slowly, and hopefully low rates will eventually help them. But
yeah, man, their stock is crushed. So is this a dip buy or is it a value trap?
Man, so I'm a little concerned at the level of cash they have on their balance sheet relative to like when they're saying they're going to get to profitability. I think they'll get there, but it's like very, very razor thin
help
margins.
them tremendously.
Yeah, exactly. It may just come down to when rates actually get cut. They actually came out on their last earnings call. The reason the stock's down this week is they said, that they're not targeting like adjusted net income profitability this year when most investors were expecting them to finally get there this year. So that means a little bit more cash burn this year, and their cash balances keep getting worked down. And so do they have to raise capital at some point? And at what price do they have to raise capital? That could be the key to what ultimately happens. So for me, it looks like a very wide range of potential outcomes where Opendoor could be, a 5 or 10x in a decade, or it could be like, basically like a no return situation if they manage it improperly. So it's going to be interesting to see.
JCPenney.
Yeah. Hopefully not quite that bad, but we'll see. Yeah.
Oh man. Yeah. Zillow's been holding up a little bit better. They're still down from all-time highs quite a bit though.
Yeah.
Yeah, but I just think like all the real estate stocks have been kicked in the teeth, and I think that there's going to be we're still kind of in this like stabilization period.
What's your take on Redfin? Redfin's an interesting one too, because I like the CEO a lot. I think they've made some interesting moves, but stock's also in the gutter and they've got some debt on the balance sheet. And
it's interesting just like having friends that have worked at Redfin, and like I think the model again is unique. I mean, I think they've been around a long time. Agents that work there tend to love it. And consumers have liked it. I think they've kind of like changed their fee structure several times over the last few years. I think consumers like the UI and like to use the interface a lot. But yeah, I just anecdotally, I've seen it seemed like a lot of people were really chasing after that savings. And I think that they're chasing profitability, and I know that they've changed their fee structure. Like I got a call this week from someone. They were like, "Hey, will you take this? It's below our minimum fee." They're trying to refer it out.
Yeah.
So I think that like that's a unique kind of transition for Redfin.
Yeah. At one point, weren't they trying to target like 3 to 4% commission rate instead of the standard 6% or something?
Yeah.
Like that?
I mean, at one point it was, I think it was
like 1.5%.
Yeah, it was kind of that setup. I mean, the 1% concept has been around for a long time. I remember when I first got licensed in 2002, there was a company in town called 1% Realty that doesn't exist. And I think the reality is like when you're only paid on performance, and then that is the end commission, it's really challenging. It's really challenging to make money. And I think that like all these companies, whether it's Open Door, Redfin, they're all trying to figure out actually at the end of the day, stock prices go up and down, but what matters is, are you profitable?
Yeah.
Like, and then at the same time are the people that are within the company and operating that drive that value. Can they make a living?
Yeah.
And I think that that's something that's certainly in flux in the brokerage world. But I think that there's much more competition than there used to be. I think that we're going to continue to see this kind of commitment to change. And I think a lot of people are just going to have to figure out how to bob and weave as things evolve.
I think for me, it's interesting because like you'll see, especially in boom real estate markets where you've got, someone who's just fresh off their real estate license, they do almost no work and, a house gets sold and they're getting paid 6%. And yeah, you could look at that situation and go, did they really deserve a 6% commission on that? Probably not. But then in other situations, like, situations that we're in right now in the Austin market where it's much harder and you have to, work through, we worked through some issues on the most recent property sale. So it was absolutely worth, paying that full rate. And you and your team put a ton of work into it. And so over a several month period. And so to me, that was like, I didn't even question it. But I think that's how people end up like seeing that 6% and saying, well, why should, this realtor who just entered the business, who knows nothing and does nothing, get the 6 and you get the same 6. And I think that's where people get tripped up.
I think it just depends. I mean, I think that, each submarket's going to be different, and I think that each deal is different. Sometimes you'll see a deal and it's like, okay, it sold in one day. Well, that agent didn't do any work. Well, that agent may have very well spent 3 months preparing that property to put it in perfect condition, which they're not charging a general contractor fee. They're not charging any of these other fees. Compass has a concierge program that we use to help get properties prepared, for market. And, those preparations, whether it's staging, photography, videography, the marketing, the branding, all that can go into, and this matters at all different price points. But as to how quickly that property sells, and keep in mind that like, the exit of a property is not fixed in time, right? Like, one agent may be able to sell a deal for 1.5, and that same agent, a different agent may only have been able to get 1.35 based on relationships, timing, how to manage the preparation of that for the market. And I think that's a huge distinction is that's the value. And I think that continues to be like, what value are you providing as an agent, right? And the idea is explaining that how you can get something to get a premium. There's a reason that like my flips, we sold one in South Austin that the average price in the neighborhood was $750. We sold ours for $950. And how did we get that? Well, we absolutely killed the design, the staging, the preparation. Everything was done and queued up. It was perfect, and the market responded positively. And I think that you can position properties really, really. I've seen some agents take some properties that are in really mediocre shape, but it's a great neighborhood, for example, and super high demand. But because of these little things that someone doesn't want to do, it can trade at a huge delta. And so like trying to figure out where those levers that you can pull. And I think that's, having someone that has a little bit of an investor mindset, on your team as a seller is always helpful too. Cause it's like, what levers do you pull to try and extract that value?
If someone who's first time buying or selling a home is looking for an agent, how do they go and find someone that's going to add that value?
I think referrals are huge, right? So like if you're moving to a new market, we have referral relationships across the country, right? So if you're moving to San Francisco or Denver, like I've got someone on speed dial that I've worked with in the past that I trust their perspective, and we tend to meet up and nationally like 2 times a year, agents at Compass to try and kind of interact and try and find people that you mesh with that also you think would mesh well with your clients. So I think that having a referral base if you're moving out of town, if you're in town, I think our biggest referral source is friends and family and people that we've worked with is going to be that referral network, and that's why
finding people in your network
that have had positive experience,
positive transactions.
And I think it's not just, it's also kind of like trying to find the right mix for your particular property. Oftentimes people will just go, well, who's the number one agent? Well, that's not always the best fit, right? Like depending on what your asset is, right? And I think it's trying to, I'd encourage everybody to interview at least 3 agents first off. And then, try and establish those referrals from your personal network. Every neighborhood's got people that sell houses, and there's other agents that tend to be like myself. I tend to sell I don't have a micro neighborhood that I only focus on. But I think that like trying to find the right agent and how you vibe with them in terms of and what value they can bring to your specific house. And I think that through that interview process, and that kind of extracts those specifics that are needed to really try and establish what value that is.
Great advice, man. 2 more questions, and then we can start to wrap it up here. What percentage of your time goes into like the realtor hat, and then what percentage of your time is like being on the investor side? And then if you were going to start over again, say like an 18 or 22-year-old guy,
right?
What do you think would be the smartest way to get into real estate? Would it be, becoming an agent, wholesaling or bird dogging or working in construction? Like if you had to do it over again, what would you do?
So to answer your first question, I'd say probably 70-30. So 70% spent on brokerage, 30% on investment. I'm unique in the sense I tend to kind of lever my investment stuff to also kind of help on the branding side for the projects that we work on. It's great content for Instagram and social media. That helps kind of establish my veracity as kind of an expert in terms of quality construction, et cetera. But I only spend about 30% of my time. In terms of a young person and what they should do, I think it kind of depends on like what your goals are. I mean, I think that if you want to become an investor, trying to get income is a great way to start, right? And I think that brokerage is a great way to do that. You can also do it through flipping. A lot of people will say wholesaling. The problem I have with wholesaling is I don't really feel like you're providing any value, right? And I think that going back to what I was discussing earlier in brokerage is I don't really want to participate in something in which you're not actually adding value, right? Typically just becoming a middleman and figuring out how to extract value from someone else is not necessarily like the best business model.
Right.
So I think that, brokerage is a great way to do it. I think working with other investors, you can join it like real estate meetups. Obviously, you've got everything in the Bigger Pockets world, all these different online forums for people to interact with people. But there's meetups in every city, and I think that trying to interact through those meetups is a great way. Brokerage is a great way because you can get into the brokerage world if you're competent, reliable, and you can show up on time. In the brokerage world, it's a great opportunity because you can get on a team and you can there's plenty of teams that are out there that need people to, whether it's open doors or like actually just be in the administrative side, and then you can kind of work your way up through those team systems. I think Keller Williams is probably one of the most prolific like training grounds for a lot of young agents. I think that's a great way to kind of like establish some knowledge, some baseline knowledge, and get yourself some income so you can actually afford to live and focus on investments, as you work your way up in the investment space. But I think a lot of people do start in the wholesaling world, and you can definitely make some money. And if you're willing to bird dog and knock on doors, it's a great opportunity. And there are a lot of people who have done really, really well. I have some friends that used to wholesale, and no hate on a lot of people that do that, because I know I'll get some comments on that.
I think that's great advice. I mean, like you said, like the being an investor is a lot easier when you have consistent income,
right?
No matter if that's trading or doing real estate. Like if you have cash flow that can sustain your lifestyle, it's way easier to be patient and wait for good investment deals.
Right. Yeah. I think the brokerage world provides a lot of experience, though. I mean, you get to see deals of all different deal sizes, depending on, some of the greatest lessons you can learn are kind of in those younger years, working with other people that you may not necessarily even be a match for. You may not want to do their job, but like you can learn a lot of things through that process, and you can gain a lot of experience. And that experience that you can gain through, I mean, that's essentially like how I got started doing this stuff. Is I kind of walked into my first development deal. I I was able to, I recognized it was a good deal. I was able to raise money, but I didn't know what a pref was. I didn't understand IRR. I didn't understand any of these things. And so, I made, quite a bit less money than I probably should have in terms of like deal structure. But I got a free education out of the deal and actually made some money on the back end.
Hell yeah, man.
And got a great opportunity, and my investors made killer returns on that. But again, it was one of those things like, I think, being willing to take a risk, spend a bunch of time without the expectation of reward requires that you actually have to be able to have some income too.
Yeah.
So I think it's trying to find that balancing act is critical.
Yeah.
And brokerage is a great opportunity to do that too.
Awesome.
So, Austin, if anyone in Central Texas is looking for expertise in real estate, whether on the investing side or looking for an agent or broker, where can they find you?
Easiest place to find me is Austin from Austin on Instagram. Easy to find.
Austin from Austin.
I like
nice.
it.
That's a good. Yeah, that's a good handle.
Yeah.
Oh yeah. Well, Austin, man, thanks for all the knowledge bombs, man. This was great.
Yeah, this was
glad
awesome.
to do it.
Appreciate it. All right, guys. Well, thanks for watching. Make sure to subscribe on your favorite podcast platform and to the new YouTube channel, wetalkmoney.com/community to check out the wealth building community. And yeah, Austin, again, thanks, man.
Yeah.
Appreciate it.
See you guys.
Thanks.
Cheers.